Good morning, everyone. My name is Adam Livingston, and I am your number one source for Bitcoin and Bitcoin Treasury Company analysis. Today, I am going to help you recalibrate how you measure opportunity cost. Traditional finance still treats the 3-month Treasury as the risk-free benchmark, but 2 decades of negative real yields say otherwise. Bitcoin's hard-capped, self-auditing protocol has quietly become the minimum return a rational allocator must exceed. If a project can't outperform that compound curve, deploying cash there is an act of charity, not investment, though the IRS won't give you a receipt. We'll examine why Bitcoin's multi-cycle compound annual growth rate, superior Sharpe ratio, and programmatic scarcity reposition it as the definitive discount rate for surplus capital. By the end, your DCF models will either clear this digital bar or join the pile marked "nice try." Remember, this is not financial advice, this is financial entertainment. Every capital project lives or dies by a single arithmetic sentence. Required return greater than or equal to the hurdle rate. The hurdle rate is the minimum internal rate of return that compensates you for 3 things in one package: the corrosive bite of inflation and the unique uncertainties of the project itself. Think of it as the high jump bar in the decathlon. Clear it and you're allowed to keep running, clip it and you're politely escorted back to the bleachers with a participation ribbon. Classically, we stack the risk-free yield, an inflation premium, and a bespoke risk spread to set that bar. If the discounted cash flow spits out an IRR lower than that composite, rational allocators leave the funds parked in the vault, patience earning more than the venture ever could. One wry observation: most PowerPoint dreams are euthanized at this gate, which is why the hurdle rate is both the guardian of discipline and the silent killer of mediocre ideas. Behold the so-called risk-free anchor of modern finance, the 3-month Treasury bill. From 2000 through 2025, its average real yield is negative 0.7%. Translation: every year the government politely hands you a certificate of depreciation and thanks you for playing. Dig deeper and you'll find that in 7 out of every 10 months, this safe asset actually dissolved purchasing power faster than a hotel minibar. Why does this matter? Because the hurdle rate is built on top of that base. If the foundation itself is eroding, every structure above it tilts. Corporate finance textbooks still add a risk premium to treasuries, but when the base number is underwater, the entire equation becomes comedic. Calling T-bills the benchmark today is like timing marathon runners with a sundial. Technically possible, functionally absurd. Once the benchmark is value destructive, the traditional hurdle collapses and we need a new bar to jump over. Contrast that crumbling fiat base with an asset whose monetary policy is written in stone, not in committee minutes. Bitcoin's terminal supply is hard-capped at 21 million coins, full stop, no emergency meetings, no temporary stimulus, just immutable math. Issuance fell roughly to 1.85% after the 2024 halving and will halve again in 2028. Asymptomatically approaching zero like a monk on a silent retreat. This cadence is pre-announced decades in advance. Every block is a mini central bank meeting whose outcomes we already know. Gold looks scarce until you realize its supply grows about 1.6% a year and nobody can predict the next monster deposit in the Andes. Bitcoin, by contrast, gives capital allocators a precision tool. You can model its inflation path to the 8th decimal with greater confidence than tomorrow's weather forecast. It's monetary policy on rails, Swiss train punctuality without the ticket fees. Here is the blunt force data. Since January 2009, Bitcoin compounds at roughly 88% a year. The S&P 500, even in its longest bull stretch in living memory, clocks in near 12. Gold, the boomer bunker asset, musters 6. In other words, Bitcoin has been lapping blue chip equities like a Formula One car stuck behind Sunday traffic. And it's doing donuts around bullion for good measure. Yes, the journey included 5 drawdowns of nearly 70% or more. But multi-cycle compounding is a tyrant. When the dust settles, the higher geometric mean wins. To beat Bitcoin, you must clear an 80+% hurdle after taxes, fees, and managerial ego. That eliminates almost every safe portfolio you've ever seen and turns most pitch decks into expensive stationery. If your model doesn't project returns north of that curve, it isn't an investment thesis, it's a sympathy card to future purchasing power. Raw returns are flashy, but finance worships at the altar of risk-adjusted performance. Think Sharpe ratio, the return you earn per unit of stomach churn. Over the last 5 years, Bitcoin's Sharpe ratio hovers around 1.5. The S&P call it 0.6. Gold barely a rounding error at 0.4. In plain English, for every ounce of volatility you survived, Bitcoin paid more than double the equity market and nearly quadruple the metal that launched 1,000 pirate movies. Volatility is the price of admission, not a defect. Judged on efficiency of returns, Bitcoin isn't a roller coaster. It's a first-class seat on a supersonic jet. Turbulent, sure, but you landed continents ahead of anybody who chose the smooth bus ride. If your proposed investment can't deliver superior reward per unit of risk, the rational allocator's response is simple. Fasten seatbelt, order another round of sats, and enjoy the flight. Here's the inflection point the textbooks will pretend they saw coming. By mid-2020, a 4-year rolling window showed Bitcoin out-returning every major asset class. Equities, bonds, real estate, even venture capital on a median basis. For institutional allocators, that was the moment the spreadsheet stopped asking, should we own Bitcoin? And started asking, how do we justify anything that doesn't beat it? Internal dashboards quietly switched reporting columns from dollars to Satoshi. Because once an asset becomes the performance denominator, the conversion flips. Stocks are now evaluated in fractions of a Bitcoin rather than the other way around. If your flagship fund earned 15% annualized from 2016 to 2020, congratulations, you still underperformed digital entities produced by hobbyists with surplus GPUs. That's not a branding problem, it's a capital allocation crisis. Meet the poster child for hurdle rate arbitrage strategy. Back in the good old days when they were known as MicroStrategy, they issued roughly $8.2 billion of convertible notes with an eye-watering average coupon of 0.421%. That's cheaper than a corporate coffee budget. They took the proceeds, bought Bitcoin, and effectively welded a turbocharger onto their equity. Here's the math. When your cost of capital is less than 1% and the assets you're acquiring has a historic compound curve of over 70, the spread isn't merely positive, it's obscene. Any traditional CapEx project a CFO puts on the docket, new data center, regional expansion, whatever, now has to clear that 70% internal hurdle just to look competitive. Good luck pitching a warehouse with a 10-year depreciation when Bitcoin is compounding like a swarm of calculators. The takeaway is brutal but elegant. Cheap fiat debt plus programmed digital scarcity creates free leverage. If your balance sheet can't replicate that dynamic, your strategic initiative is at best an expensive pet project. Picture yourself screening for opportunities in a small cap pops with a tidy 12% post-tax IRR. In the fiat universe, you'd be uncorking champagne. Shift the denominator to Bitcoin and that same 12% morphs into a slow leak of purchasing power, like filling a swimming pool with a garden hose while the drain is still open. So the decision tree is blunt if you're an investor. Number 1, model Bitcoin's forward compound annual growth. Use a conservative 25% if the historic 80+ seems a bit too spicy. Number 2, subtract your candidate's net return after fees, taxes, and slippage. Number 3, if the spread is negative, step away from the order ticket and allocate to BTC instead. Only ventures with asymmetric upside and genuinely uncorrelated drivers survive the audit. Everything else becomes an involuntary donation to the protocol's growing Gini coefficient. In short, beat the bar or keep stacking sats. Portfolio construction in one ruthless sentence. When savers realize they can lock purchasing power in self-custodied sats, government's bond auctions start to resemble a Saturday morning garage sale. Plenty of paper, not enough buyers. As that bid thins out, coupons creep higher to lure capital back, an invisible surtax on future taxpayers. In fiscal year 2024, the United States already ran a $1.8 trillion cash deficit. Add a 1 percentage point rise in average funding cost and interest expense snowballs by roughly $280 billion per year. Here's the kicker. Every basis point concession the Treasury makes resets the private sector hurdle even higher, because corporate and municipal issuers price off the sovereign curve. Bitcoin, simply by existing, ratchets the global cost of capital upward, an actuarial guillotine for budgets built on negative real yields. So while politicians debate line items, the market quietly asks, Why lend at 4% in melting fiat when a digital bearer asset has a 20+% return track record? Objection 1, Bitcoin is too volatile. The price chart looks like an EKG after 3 espressos, but stretch the holding period to 4 years and 88% of all entry points beat inflation. Volatility isn't risk, selling into it is. Objection 2, the law of large numbers will throttle future returns. Bitcoin's market cap is about $2 trillion, gold hovers near 20 trillion, equities north of 100. Even a $10 trillion Bitcoin merely matches a single legacy store of value. Room to run is measured in orders of magnitude, not basis points. Objection 3, regulators could kill it. Spot ETFs and Bitcoin reserves are here. Governments rarely outlaw revenue streams they just licensed. In short, each objection is a speed bump masquerading as a roadblock. When the data are audited, the risk that matters most is opportunity cost. Missing a compounding curve because the narrative felt uncomfortable. Here's the practical treasury hack. Segregate liquidity by half-life. Your operating runway of 12 to 18 months stays in short duration fiat. Payroll, vendors, tax man, the boring stuff. Everything beyond that horizon faces a two-step interrogation. Will this deployment compound faster than a conservative Bitcoin base case? Say 25% real? Can it match Bitcoin's self-custody liquidity and counterparty risk of precisely 0? If the answer to either question limps, surplus cash auto-converts to sats. Think of it as a kitchen faucet with a built-in thermometer. Lukewarm projects are diverted down the Bitcoin drain before they scaled the balance sheet. This dual benchmark discipline doesn't turn companies into crypto hedge funds. It simply reorganizes that idle cash. It must earn its keep beyond the short term. In a world where scarcity is programmable, the cost of complacency is compounding. The decision is binary: jump higher or keep stacking sats. One path preserves optionality and compounds time value. The other wages your capital will outrun programmable scarcity, armed with over 16 years of an undefeated track record. Choose wisely, your balance sheet is already voting. Now, congratulations, you've just audited your entire capital stack through a Bitcoin lens. If your models now look like museum relics, that's progress. Here's the actionable takeaway. Run the BTC audit on every deployment of surplus cash. Publish the delta. Transparency terrifies mediocrity. Reallocate ruthlessly. Beat the bar or default to stacking sats. Then share this with anyone still quoting the risk-free rate like it's 1999. Because in an era of program scarcity, the only true risk-free asset is discipline, and Bitcoin has already priced that in. My name is Adam Livingston. If you enjoyed this content, please like this video and subscribe to my channel in order to support my work. I'll see you all tomorrow for some more financial entertainment. Class dismissed.